Imagine this situation. You wake up one morning, open your banking app, and everything looks exactly the same as yesterday. Same balance. Same numbers. Same familiar screen. But somewhere across the world, in a government office in Beijing, in a vault in Singapore, in a boardroom in Riyadh, decisions are being made right now that will quietly, and irreversibly, change what that number is actually worth. And nobody on financial television is telling you about it. What is happening right now is not a market correction. It is not a geopolitical blip. What you are watching, if you know how to look, is the largest financial reset in 80 years. A complete reorganization of the global financial order. A transfer of power, capital, and wealth on a scale the world has not seen since the end of World War II. And here's what they don't want you to know: in every single moment of transition like this one, there is a massive shift of wealth. It moves from those who hold the old assets to those who understand what the new world actually values. The people who position themselves correctly before the transition becomes obvious don't just preserve what they have. They multiply it. Dramatically. I have spent months studying exactly this. And today I am going to show you what is really happening, why it is happening now, and where the real opportunities are hiding in plain sight while most people are completely distracted. Stay with me. Because by the end of this video, you are going to understand something that the vast majority of investors, including many professionals, have not yet connected. And that gap in understanding is exactly where financial opportunity lives. If you are new here, this channel exists because someone needs to tell you what they won't. Subscribe to Money with Maya right now, because what I am about to show you is exactly the kind of content this channel was built for. For nearly 80 years, the global financial system ran on a very clear set of rules. The US dollar was the world's currency, not by accident, but by design. American institutions were the gatekeepers of global commerce. Globalization meant produce where it is cheapest, sell where it is most profitable. Those rules sustained decades of growth, trade, and relative peace. But those rules are ending. To understand why this is happening now, I need to take you back, because this story follows a pattern that has repeated itself throughout economic history. Every time the world goes through a major technological revolution, and every time the dominant power begins to show signs of weakness, capital migrates. It moves out of financial assets and into real assets. Out of developed countries and into emerging ones. Away from whoever holds the technology and toward whoever holds the physical resources that technology requires. This pattern repeated in 1870 with the Second Industrial Revolution. Fortunes were made by countries with coal, steel, and copper. It repeated in the 1970s when the oil crisis reorganized global power overnight. And it repeated in the early 2000s with the commodity supercycle driven by China. In the late 1990s, the world was euphoric about the internet. Technology companies were worth billions without a dollar of revenue. The United States was the center of everything. Emerging markets were completely forgotten. Then the Nasdaq collapsed. The S&P 500 lost nearly half its value in 2 years. September 11th happened. And in that moment of American weakness, China began quietly changing the game. China joined the World Trade Organization and began growing at 10, 11, 12% per year, building entire cities from scratch, moving hundreds of millions of people from rural to urban, creating the largest infrastructure boom in human history. And to do all of that, China needed everything. Steel, coal, copper, iron ore, oil, food. What happened next became known as the commodity supercycle. Oil went from $30 to $140 per barrel. Copper tripled. Iron ore multiplied by 10. It was one of the greatest transfers of wealth of an entire generation. But then the world made a quiet decision that created a time bomb detonating right now. The world decided that mining and commodities were things of the past. Why invest in opening mines when you could invest in Apple, Google, or Amazon, companies growing at 40% per year, companies that needed no land, no minerals, no extraction? Clean. Digital. The future. The numbers show what happened next with brutal clarity. In 1900, the mining industry represented 10% of total global market capitalization. In 1960, still 11%. Today, 1.8%. An absolute historical minimum across 125 years of data. The sector responsible for producing every metal the world uses was literally forgotten by investors. And it was not just money that left. Investment and productive capacity left with it. Western nations outsourced metal production to countries willing to accept the pollution and costs that production generates. The result is that today the United States depends on imports for nearly half of its critical mineral consumption, and the single largest supplier in almost every category is China. This is where everything gets complicated. And this is the moment I need to tell you about February 24th, 2022. On that day, Russia invaded Ukraine. And within days of the first attack, the West responded with what was called the mother of all sanctions, the freezing of $300 billion in Russian reserves. Money the Russian central bank had accumulated over decades. A financial cushion saved precisely for moments of crisis. And with one decision from Washington, it disappeared. Technically it existed. But it was inaccessible. Frozen. Useless. Now I want you to stop for a moment and think about this from the perspective of every other country watching that happen. Not Russia. Any country. China. India. Saudi Arabia. Turkey. Any nation that kept its reserves inside the Western financial system, because that was what everyone did. Because it had always been considered the safest place in the world. The question that arose in the minds of all of those countries at the same moment was devastatingly simple: if Washington can freeze $300 billion with one decision, what prevents them from doing the same to us? The answer was terrifying. Nothing. That was the moment the confidence underlying the entire system cracked in a way it never had before. Since the end of World War II, the US dollar was the world's reserve currency backed not by gold. Nixon ended that in 1971, but by something equally powerful: trust. The trust that the American financial system would be neutral. That reserves held in dollars would be safe regardless of who you were or what your relationship with Washington looked like. That trust was the foundation of everything for 80 years. In February of 2022, that foundation cracked. And guess who noticed it faster than any other country on Earth? China. In 2013, China held $1.3 trillion in US Treasury bonds. Today that number has fallen to less than $600 billion. A reduction of more than half in just over a decade. China was selling and selling and selling, quietly unwinding its position in American bonds. Where did that money go? Into gold. And after the Russia sanctions, China massively accelerated its physical gold purchases. A metal that no one can freeze. That cannot be blocked with a single decision. Central banks around the world began making the same move. In 2022, 2023, and 2024, global central bank gold purchases hit consecutive historical records, surpassing 1,000 tons per year for 3 straight years. For the first time since 1996, nearly 30 years, foreign central banks are holding more gold in reserves than US Treasury bonds. Meanwhile, the United States has a problem that makes all of this even more urgent. At the end of 2025, U.S. federal debt reached $38 trillion. It grows by $6 billion per day. In 2025, the United States paid nearly $1 trillion in interest alone on that debt, more than the entire defense budget. And historically, Governments have only one real exit from this kind of debt spiral: print more money. Inflate the currency. Dilute the purchasing power of everyone holding wealth and paper. Since 1913, the dollar has already lost 96% of its purchasing power. It is like a glass of orange juice where someone keeps adding water. The juice is still there, but less and less orange. Less and less value. Ray Dalio spent 50 years studying economic cycles going back to 1350. He calls this the big cycle. He says these moments of rupture happen every 75 to 100 years, and they always follow the same pattern: excessive debt, monetary printing, loss of confidence, flight to real assets. He also says that when they arrive, those who understand what is happening and position themselves correctly can multiply their wealth in ways that seem impossible to everyone else. That is not speculation. That is documented history, repeating itself right now, in real time, in front of all of us. Sound familiar? Subscribe to Money with Maya, because this is exactly the kind of analysis your bank will never give you, and mainstream financial media will never connect for you. The next part of what I am about to show you is where it gets truly extraordinary. Now, there is a force accelerating everything I have just described. A force that the cycle of 2002 did not have. Its name is artificial intelligence. The AI revolution is frequently compared to the internet. But that comparison dramatically underestimates what is actually happening. The internet changed how we communicate. Artificial intelligence is changing human cognitive capacity itself. And here's what no one is telling you about it: AI is not a clean, digital revolution. It is the most resource-hungry technological shift the world has ever seen. The data centers that AI requires consume extraordinary amounts of energy. A single large-scale data center can consume as much electricity as an entire city. Amazon, Google, Microsoft, and Meta will spend between $650 and $700 billion combined on AI infrastructure in 2026 alone. For reference, that is the entire annual GDP of Argentina, spent in a single year, by 4 companies, on data centers and chips. And to build all of this, the world needs copper. Massive quantities of copper. Each large data center uses between 20 and 40 tons of it. Electric vehicles use 4 times more copper than combustion engine cars. The expansion of power grids, solar panels, wind turbines, all of it requires copper in every cable, every transformer, every connection. Demand for copper is projected to grow 35 to 40% by 2030. Supply grows 3% per year. A copper mine takes 10 to 20 years to develop. The deficit has arrived and it will get worse. And the price of copper is already at historical highs, up 32% in the last 12 months alone. Something else happened in early 2026 that had never happened in 40 years of international copper pricing history: the treatment and refining charge, the fee that smelters charge to process copper concentrate into refined metal, was set at zero. Zero. It means there is so little raw copper concentrate available that smelters are essentially working for free just to keep their operations running. That is not a market signal. That is a market screaming. But of all the physical metals in this story, there is one living through a moment so dramatic, so misunderstood, and so disconnected from its true value that I need to spend real time on it. That metal is silver. Here is a dissonance that once you understand, you cannot ignore. Silver is 8 times rarer than gold above ground, accounting for all the material ever mined in human history. Yet gold costs 80 times more than silver. 8 times rarer. 80 times cheaper. How is that possible? The answer is in monetary history. For centuries, silver and gold were both used as money. But throughout the 20th century, governments progressively demonetized silver, selling reserves, ending silver coinage. Gold stayed as a central bank reserve. Silver was demoted to an industrial commodity and spent decades being ignored by financial markets. But silver is simultaneously three things, and this unique combination is what makes what is happening now so extraordinary. It is a monetary metal that central banks are beginning to reaccumulate. It is an industrial metal with irreplaceable physical properties. And it has become the strategic metal of the clean energy revolution because solar panels use silver. Enormous amounts of silver. AI needs data centers. Data centers need energy. The fastest growing clean energy source in the world is solar. And every solar panel uses silver because silver is the best electrical conductor among all metals. Better than copper. Better than gold. Better than anything. Here is the cruel irony: the most modern solar panels are more efficient, but they use more silver per panel, not less. The more efficient the panel, the more silver it requires. In 2023, the solar industry consumed 232 million ounces of silver. In 2024, 270 million ounces. Projections for 2030 suggest more than 500 million ounces per year from solar alone. Total global silver production in 2024 was approximately 1 billion ounces. The solar industry alone is heading toward consuming half of all silver produced in the world. And the supply problem has a characteristic that makes it even more severe: 72% of all silver does not come from silver mines. It comes as a byproduct of mining copper, zinc, and lead. You cannot simply produce more silver when demand increases. The supply does not respond to price the way other commodities do. When inelastic demand meets inelastic supply, the result is a structural gap. An imbalance that does not resolve quickly, and that when it manifests in price, creates movements that are violent and long-lasting. The silver market is in deficit for the fifth consecutive year. Physical silver inventories at the COMEX, the main U.S. futures exchange, have collapsed from 329 million ounces at the start of 2025 to less than 87 million ounces today. A fall of more than 75% in less than 1 year. The same collapse is happening simultaneously in Shanghai. The two largest geopolitical rivals on the planet are both moving toward the same asset at the same time, each trying to secure its own supply. China restricting silver exports. The United States declaring it a strategic material. There is no quick exit from this problem. Now let me bring this all together into the insight that most investors are completely missing. Stan Druckenmiller, arguably the greatest macro investor of all time, with 30% annualized returns over 30 years without a single losing year, said recently that macro is back. That the world no longer works the way it did for the past 15 years. And how he is positioning his portfolio reflects exactly this. He moved entirely out of AI and technology stocks and repositioned into Japan, South Korea, and commodities, especially copper and gold. A clear structural bet against the dollar. This is the same move the great investors made in 2002, when they recognized that the era of American technology dominance had paused, and that the world was entering a commodities and emerging market cycle. In the commodity cycle from 2000 to 2011, physical gold rose 660%. But gold mining stocks rose 1,475%. Miners delivered 2.2 times the performance of the metal itself. That is the natural leverage of the sector. When the price of gold rises, margins explode, cash flow multiplies, and stock prices rise far more than the metal. In the current cycle, from 2023 to today, physical gold has risen 188%. Mining stocks rose 259%. But the leverage ratio is only 1.37 times. In the previous cycle, miners delivered 2.2 times. Today, 1.37 times. If you apply that same historical leverage to the current gold movement, mining stocks should not be at 259%. They should be at 421%. There is a significant gap between where miners are and where they historically would be at this stage of the cycle. For silver miners, the gap is even larger. Silver has risen 275% since 2023. Silver mining stocks rose only 305%, a leverage ratio of just 1.1 times. In the 2000 to 2011 cycle, silver miners delivered 2 to 3 times the metal. Apply that historically, and silver miners should not be at 305%. They should be closer to 700%. Understanding this mechanics before most people do is exactly where wealth is built in these great cycles. The difference between those who multiply wealth and those who are swept away is not luck. It is understanding. Knowing what is happening before it becomes a headline. Positioning before the crowd arrives. Here is what I want you to take away from this video. The global financial system cracked in 2022. The dollar is losing its hegemony. Central banks are buying gold at record volumes. The artificial intelligence revolution has created a demand for physical resources the world cannot currently meet. Mining was forgotten for decades and is now the most strategic sector on Earth. Silver is in simultaneous physical scarcity in New York and Shanghai. The greatest macro investors in the world are quietly repositioning. And the mining stocks that carry the most leverage to this cycle have not yet delivered the performance that historical precedent would suggest they should. The window is open. It will not stay open forever. This knowledge is a real advantage. In the great cycles of history, the gap between those who multiply wealth and those who are erased by the tide is never luck. It is understanding. Connecting the dots before they become obvious. Positioning before the narrative reaches the mainstream. You now know what most people do not. The question is what you will do with it. Subscribe to Money with Maya, because this is just the beginning. This channel exists because someone needs to tell you what they won't. And I am just getting started.